Yeah, well, one of the big headwinds right now is just the supply constraints. Because of, say, the war in the Ukraine, we have a shortage of raw materials. Think of oil prices over $110 a barrel. It's creating all this supply production constraints. Just what's happening in China with their COVID lockdown. You hear Shanghai is not producing as much, shipping it out. So once again, we're seeing the shortage of computer parts and things that we need here in the United States to finish making our final goods like cars and appliances. So what's happening in Europe with the war and what's happening in China with COVID, it's still affecting our supply side. We had hoped that those things would be worked out by now, that the COVID and the whole pandemic would be pushed aside, and we weren't expecting a war in Europe pushing up oil prices and then food prices. So we're still dealing with that on the supply side. So that's still a major headwind. On the tailwind side, we still have consumers flush with cash. At my presentation just a while ago, I mentioned that 2 years ago, the average credit union member had about $11,000 deposited at a credit union. That's their checking account, savings account, CD money. The average had $11,000 2 years ago. Today, it's $14,200. So it's gone up $3,200. They're sitting on a pile of liquidity, which is great purchasing power to go out and buy appliances, go on trips, help down payment on a house. So that should keep driving the economy forward. That's why we're not forecasting a recession. In my presentation, I said, yeah, we're not forecasting a recession because consumers make up 70% of the economy, and they're sitting pretty well right now. Well, the good news is we actually have seen inflation, the year-over-year inflation, come down a little bit. The latest number that came out, we're at 8.2% year-over-year inflation. That's down from 8.5. So we are moving in the right direction, but it's still way higher. The Fed wants to see it at 2%. We're at over 8%, so it's 4 times higher than what it should be. So it is both demand side and supply side. We call it demand pull inflation, where you and me got all the stimulus check money, so we're spending it. That's the demand side. But then we still have the cost push inflation, which all the supply chain disruption. And the Federal Reserve is really hoping that cost push inflation can start coming down, that oil prices will start coming down, that parts will flow in quicker from the port of Los Angeles, from Taiwan and China, and that'll help with all our parts, and that will help bring prices down. So we got to get both supply and demand. That's what economics is all about, working together and bring, increase supply and bring down a little bit demand. That's what the Federal Reserve is doing. The Federal Reserve is trying to slow down demand a little bit by raising interest rates. You raise interest rates, we're already seeing it. The housing market is slowing down. This morning, the government just came out with new home sales. And in the month of April, new home sales fell 16% at an annual rate. That's a big drop, 16%. So, as we all know, the housing market is one of the most interest rate sensitive sectors of the economy. When interest rates go up, housing construction, housing sales drop off. So we're already seeing the slowing, and the Fed might be saying, well, it may be slowing a little bit too fast, and but we still expect the Fed to raise interest rates, but they may be reevaluating how much they have to raise interest rates. Yeah, because the economy is overheating. And there's an old rule of thumb in kind of the Federal Reserve world that 2.5% interest rate is kind of the neutral interest rate, where they're not trying to stimulate the economy or not trying to restrain the economy. But right now, they have the short-term Fed funds rate at 0.83%. So 2.5% is considered like neutral, normal. And so they're still in very stimulative mode at 0.83. So they got to get up to 2.5 just to get to neutral. So basically, they still got their foot on the monetary accelerator, which a lot of the economists say, yeah, take your foot off the accelerator. We don't need it anymore. Get it up at 2.5 as quickly as you can. And they might have to go above 2.5. In fact, at my presentation, I was forecasting they'll probably hit 2.5, maybe by the end of this year, going into the beginning of next year, and then go up to 3.25, a little bit above that 2.5, just to restrain the economy, restrain demand a little bit, to bring inflation down. So yeah, I agree with the Fed, but it's going to be really challenging for the Fed to figure out how fast to raise interest rates and for how high they should go. It's very difficult because you're dealing with an economy that's over $20 trillion with a lot of moving parts. But yeah, they need to raise interest rates. They're still too low. Very stimulative interest rates, which, as you know, the economy doesn't need more stimulation, they need less. Well, we know last year we saw home prices in this country rise 18–19%. There's different measures of home prices, but on average they're up 18–19%, which is clearly not sustainable. In the long run, there's a ratio economists look at. The price of your home goes in the numerator, and then your income, the average American income, goes in the denominator, and you want that ratio to remain somewhat constant in the long run. But in the last couple of years, the numerator, the price of homes, has gone up 18%. But the denominator, incomes, what the average American is getting for a raise, is only going up 5–6%. So that ratio is getting out of whack. It's basically getting too high. And so we can't keep home prices rising 18%. Because after a while, nobody's going to be able to afford a home anymore. And so we're going to have to see that slow down. We're forecasting this year, however, that home prices will rise probably another 9%, which is still faster than most people's income, the denominator of that ratio, which is only growing 5–6%. But there's still so much demand out there. You have all these millennials. There's 83 million millennials out there, ages 26 to 40. Well, what do you do when you're 26 to 40? You're getting married, you're having kids, and you're buying homes. So you got all these millennials out there needing to buy homes, and there's just not much supply out there. Normally we should have about 3 million homes for sale in this country. Think of a house with a for sale sign jammed in the front yard. 3 million is like normal. Today we have less than 1 million. So we have 1/3 the inventory of normal. Well, basic economics says you got a lot of demand with limited supply, price is going to go up. So we expect price to go up another 9% this year. But then next year, we have this phrase in economics called a reversion to the mean, that over the long run, your home is going to go up 4% a year in the United States. 4.1, 4%, that's like normal. Next year we're forecasting it to drop to 4%. So this year 9%, last year we had 18, next year 4%, and then in the out years, going into the year 2025, 2026, home prices may be only going up 1%, below the 4% long run average. The big thing is those higher interest rates will affect us already. It is affecting credit unions already, especially in the mortgage department. Those higher interest rates, just the latest numbers out from the Mortgage Bankers Association, that mortgage applications, you and me going into the credit union, filing for mortgage applications, they're down 50% from this time last year. Now this is data for all lenders, so you got banks, credit unions, and mortgage brokers, but they're down 50% because of the increase in interest rates. Last year mortgage rates were around 3%. Today they're at 5.3%, so they've gone up significantly. So mortgage originations are down. So credit unions are just going to not originate as many mortgage loans. And as you know, we've been originating a lot of loans, and then we sell them off into the secondary market, to Fannie Mae, Freddie Mac. And then we make, so it's called gains on sales of mortgages, and that is going to be down this year. Credit unions' income from the gains on sales of mortgages will be down, which is going to reduce our bottom lines. Our return on assets, which is normally, the older rule of thumb is like a 1% ROA ratio, maybe down to about 0.8 this year because of that. So we're already seeing a big drop in the mortgage department. But offsetting that, the good news is new auto loans are up, home equity loans are way up. Because of that big increase in home prices, you and I may have some equity in our house to tap into, and we're seeing home equity loans growing about 12% right now over the last year, which is one of the fastest growing loan categories at credit unions. Well, the labor market is going to remain tight. We're forecasting the unemployment rate to remain below normal. So expect a labor shortage for the next few years. Expect wages to be growing faster than normal. Expect employees to have a little bit more bargaining power. They want better wages, better benefits, maybe work remotely, and a bigger churn rate. The quit rate right now in the United States is over 3%. So just think, on any 1 month, 3% of the credit union employees could be quitting, either maybe because of retirement or they have better opportunities elsewhere. So we're going to have a very tight labor market for the next 4 or 5 years.